Welcome to the De-Risk Daily Brief. It's Thursday, November 6th. Yesterday's narrative was all about policy paralysis in the face of a slowdown. Today, that story is fracturing. The new theme is a great macro divergence, a fierce tug-of-war between surprisingly resilient economic data on one side and undeniable signs of stress and political dysfunction on the other. This conflict is leaving markets without a clear directional bias. U.S. futures are slightly positive this morning, but it's a low conviction drift. The real action yesterday was under the surface. The ISM Services PMI came in much hotter than expected, directly challenging the recession narrative. Yet, the dollar remains soft, and the VIX, while lower, is still holding stubbornly near 18. It's a picture of profound confusion. The market is getting conflicting signals from every direction and doesn't know which one to trust. Alex, this feels less like paralysis and more like a market being pulled in two opposite directions at once. How is this global divergence playing out? Starting with the overnight session in Asia.
That's exactly right, Sarah. The divergence is global, and it's creating policy headaches everywhere. Let's start in Japan, which is a perfect microcosm of this conflict. On one hand, you have political pressure from a junior coalition partner urging the Bank of Japan not to hike rates, fearing it would stifle investment. But on the other hand, the BOJ's own minutes show a growing debate about hiking, fueled by core inflation at 2.5% and wage growth hitting 4.5%. The Nikkei is in a technical uptrend, but it's trading on this fundamental uncertainty, unable to break out decisively. That same tension exists in China. We have Premier League projecting a massive $24 trillion economy by 2030, a powerful long-term bullish signal, but in the here and now, the market is still grappling with a fragile recovery. So while the Hang Seng is showing technical strength, investors are hesitant to fully commit when the long-term rhetoric doesn't match the short-term reality. This theme of division carried straight into Europe, with the Bank of England as the main event. They held rates at 4%, but the vote was a razor-thin 5-4 split, with 4 members wanting an immediate cut. It's the definition of a divided committee. They're trying to telegraph a dovish pivot, talking about gradual easing, but the split vote reveals deep disagreement on how sticky core inflation really is. This is injecting volatility into sterling and leaving the FTSE and DAX in a holding pattern, technically bullish, but fundamentally exposed to this policy confusion. And that brings us to the U.S., the epicenter of this divergence. Yesterday's data was a head-scratcher. The ISM Services print at 52.4 and the ADP jobs number beating expectations should have sparked a risk-on rally, but it didn't. Why? Because that strength is being completely offset by the drag from the record-long government shutdown, rising consumer loan delinquencies hitting a 5-year high, and a housing market already in recession. The AI-driven tech boom is keeping GDP afloat, but the average consumer is clearly struggling. This conflict is paralyzing asset classes. In fixed income, the 10-year Treasury yield is trapped. Strong data wants to push it higher, but the shutdown and consumer stress are capping any move. In FX, the dollar is weak on the political dysfunction in Washington, but the resilient data is preventing a true breakdown. The DXY is hovering just below 100, caught in the crossfire. Commodities are telling the story perfectly. Gold is whipsawing. It rallied past $4,000 on safe haven demand from the shutdown, then got knocked back by the strong ISM data. It's literally trading the macro confusion. Crude oil has a clearer path, but it's a bearish one. Yesterday's massive inventory build was confirmed, screaming demand destruction. WTI is struggling to hold $60 as the weak consumer outlook outweighs any supply-side concerns. Finally, the VIX is down below 18, but nobody is celebrating. This isn't a sign of complacency. It's the price of confusion. The market has moved past pricing a clear slowdown and is now just trying to price this radical uncertainty. Back to you, Sarah.
So the market is caught in a stalemate, pinned between a surprisingly robust services and tech economy and a clearly weakening consumer and industrial base. With this deep divergence in mind, today's data and Fed speak become even more critical. The weekly, initial, and continuing jobless claims will give us the next read on the labor market's health, a key piece of this puzzle. But the main event will be the parade of central bankers. We have a slew of Fed officials speaking throughout the day, including Barr, Williams, and Waller. The market will be desperate for any hint on how they are interpreting these conflicting data points, especially with the ongoing data blackout from the shutdown. Across the Atlantic, the conversation continues. We'll hear from the ECB's Nagel and Lane, and crucially, Bank of England Governor Bailey will hold his press conference following that split rate decision. Traders will be parsing every word for clues on which side of that 5-4 vote is likely to win out in the months ahead. It's a day where the market is searching for a tiebreaker, but is unlikely to find one. We'll leave it there. Thanks for listening to the D-Risk Daily Brief. Disclaimer, this podcast is for informational purposes only and does not constitute financial advice. All investment decisions should be made with the help of a professional.